One of the world's finest investors, Warren Buffett, has earned enormous riches through his creative investment strategies and financial know-how. His success and wisdom made him a sought-after financial advisor. Over the years, Buffett has given advice that can help people get started on the path to financial success. In this video, we'll look at Warren Buffett's top 10 personal finance tips, which can help anyone improve their financial situation. Beginners can build a stable financial future by following these rules and learning from one of the world's most successful investors. But before that, watch the video till the end and subscribe to our channel now. Also, press the bell icon for more useful future updates. Let's get started. Number 10. Diversification is not always a good idea. Warren Buffett disagrees with diversity, a popular investment strategy. Buffett says that diversification is mostly for people who don't know much about investments. He thinks that experienced buyers should choose stocks for the long term and keep believing in them. Some diversify to protect their portfolio from a single stock, but this makes it tougher to track company news. Diversification can make a portfolio less volatile, but it also makes it harder to keep track of each purchase. Buffett, on the other hand, only invests in his best ideas because he knows that great companies at reasonable prices are hard to find. He waits calmly for the right time to buy good stocks, and when it comes, he makes the most of it. Number 9. Invest in companies you understand. Buffett's timeless advice tells us that our comfort today comes from investments made in the past. By planting and taking care of the seeds of financial success now, we can enjoy the shade in the future. This shade stands for being debt-free, having a safe retirement, and being able to pay for our children's schooling. Buffett looks at investments from a long-term point of view. This shows how important it is to focus on multi-decade horizons and big gains in buying power. He tells investors not to let short-term market changes or economic disasters make them change their minds. Even though there may be problems on the way to real wealth, taking a long-term view of money will give you a strong base that can stand up to problems. Number 8. Trust low-cost index funds for your portfolio. Warren Buffett, known for his wisdom and guidance, suggested that the normal investor should use index funds. Even though Buffett is very good at picking stocks, many people were surprised when he wrote in his 2013 shareholder letter that he liked passive index funds. He had been arguing for this method for years, so it wasn't a new idea to him. In fact, at the 2004 Berkshire Hathaway annual meeting, Buffett said, "If you invest in a very low-cost index fund and average your returns over 10 years, you'll do better than 90% of people who start investing at the same time." Many investors are attracted to low-cost indexing because most professional stock pickers struggle to get returns that are high enough to support their higher fees. Number 7. Choose the right news to focus on. Warren Buffett gives a good business tip when he says that we shouldn't put too much weight on every news story we see. Buffett says that the most important thing is to follow the 99-to-1 rule. He says that many buyers base their decisions on only 1% of the financial news they hear. This means that they often sell their stocks quickly when bad news comes out, like a 10% drop in a company's sales. Buffett says that a company that has been in business for a long time, like a century, is more likely to be able to handle these kinds of problems. In effect, Buffett points out that people tend to overreact, and he urges investors to keep a balanced view. Number 6. Never compromise on business quality. Identifying high-quality enterprises can be more difficult than just rejecting complex industries. Warren Buffett's business philosophy has changed over the past 50 years. Now, he mostly buys companies that are good and have a good chance of growing in the long run. The name Berkshire Hathaway comes from one of Buffett's worst bets, which is strange. The ability of a business to make high and stable returns on invested capital is a key factor in figuring out its value. This shows that the company has an economic moat. Instead of giving in to the allure of a 10% dividend yield or investing in a company that seems to be trading at a low 5x earnings ratio, it is important to fully evaluate the company's business and feel happy with it. Number 5. Know the difference between price and value. When making a purchase, especially an investment, it's important to know that the price you pay and the real value you get is often different. Always consider the business's fundamental value, not just the price. You should buy a stock if you think its share price is lower than what the company is worth. For example, if the market as a whole drops by 10% during a market downturn, that doesn't necessarily mean that the business itself is worth 10% less. In the same way, a quick rise in the price of a stock does not always mean that the value of the business has also gone up. When investing, it's important to look at price and value as two different things. Number 4. Buy stock and hold it forever. Warren Buffett believes in the buy and hold strategy and holds his investments for long durations. Buffett keeps a focused portfolio because it's hard to uncover great companies with long-term prospects. Also, high-quality businesses usually make a lot of money and increase in value over time. Buffett said it right when he said that time favors great businesses because fundamental reasons take years to affect stock prices, which rewards patient investors. On the other hand, frequent trading hurts investment returns through taxes and bad choices caused by our natural tendencies. So it is often better to have the mentality of buying right and sitting tight. In Buffett's words, the stock market is set up to move money from traders who are constantly buying and selling to patient traders. Number 3. Keep cash on hand. Having cash on hand is a key part of staying safe. In the 2014 Berkshire Hathaway annual report, Warren Buffett stressed this point by saying that the company always has at least $20 billion in cash resources and often has more than that. Businesses and people alike may feel tempted to spend their cash on hand, but Buffett says that cash is like air for a person, which shows how important it is for a business. When cash is there, it's easy to forget about it, but when it's gone, it's the only thing that matters. When bills need to be paid, only cash is considered legal tender. So Buffett stresses how important it is to never leave the house without a lot of cash. Number 2. Invest in yourself. Warren Buffett says that the key to success is to invest in yourself. He says that improving your skills and talents should be your top priority because you are your most important asset. Buffett thinks that most people will make their money through their jobs rather than the stock market. So he tells people to first put money into themselves. Charlie Munger, his business partner, agrees with him and advises spending an hour a day on self-improvement. Buffett says that if you invest in yourself, you will get 10 times what you put in, and unlike other investments, it can't be taxed or taken away. Investing in yourself is important to becoming great, and it's not just about money. Number 1. Never lose money. One of the most well-known pieces of advice from Warren Buffett is to put the preservation of wealth first. His first rule was, never lose money. Rule number 2. Never forget rule number 1. Stresses how important it is to avoid losses to be successful in investing in the long run. This concept may seem simple, but it has a deeper meaning. Buffett emphasizes capital preservation and minimizing risk. By making sure your stock doesn't lose money, you're more likely to make money over time. This way of thinking sets Buffett apart from people who use the stock market as a place to gamble and shows how important it is to have a smart investment plan. By following these tips, focusing on the long term, and staying inside our circle of competence, we can better manage our portfolios and reach our goals. That's all for today's video. Hope you liked the video. Subscribe and hit the bell icon for more updates. Thanks for watching.